Hey, here, Kevin Matthews, top 100 financial advisor, two-time author, one-time bestseller, and we have some breaking news within the last 2 hours or so. The Fed has decided to cut interest rates. This is going to affect you as a consumer, and it's going to affect you as an investor. So I want to briefly explain what the Federal Reserve is, why they cut interest rates, what that means, and again, how it affects you as a consumer and an investor. So this is buildingbird.com. You can follow me and do all the things there. Here, you want to make sure you hit the free classes button here as well, but we'll come back to this in a few minutes. So I like CNBC. They are really simple when it comes to explaining what's going on and just easy to understand language. So if you're a new investor, you want to figure out like what's going on in the market, CNBC is one place to go other than my website and all of my socials out there on the interwebs. Now, as you can see here, this is the big running story. You're going to hear a lot about this over the next few days. The Federal Reserve cut their interest rates to zero. Now, who is the Federal Reserve? What does this mean, and why does this affect you? The Federal Reserve, essentially, when you break it all down, is the bank's bank. So Bank of America, Capital One Bank, Chase, all of them bank at the Federal Reserve, essentially. And the Federal Reserve pays banks an interest rate just like they pay you and me. So when the Federal Reserve raises their interest rates, banks obviously put more money into the Federal Reserve because they can get paid a guaranteed interest rate. The same way that me and you, when there's a really high interest rate, 2-3%, we say, instead of going spending my money, instead of doing other things, I'm going to put my money in the bank. So when they raise interest rates, this means that your credit card interest rates tend to go up. This means that your savings rates tend to go up, and everybody just tends to save and they don't spend. The reason, or they spend less rather. The reason why the Federal Reserve would do that is when we want to kind of slow down the economy, when things are a little too hot, or when we feel like the economy is better off, then we raise interest rates. We say, hey, people want to save, they want to grow their money, we're going to raise interest rates. That's when things are raised. The Federal Reserve raised interest rates a few years ago, like 2016, 2017, after we were out of the Great Recession. We said we were better off. Now people are willing, they have more money, they can save now. Let me raise the interest rates. And that's how a lot of these online banks were popular again. Ally was paying like 2.5%. That's why that happened, because the Federal Reserve raised their interest rates. Now we're in an opposite situation. So when the economy is healthy, they raise the interest rates. When the economy is not healthy, they cut the interest rates. They had cut it a few weeks ago, and they had cut it like back in December, if I remember correctly. Now they cut it to basically zero, which is a concern depending on how you look at it. The last time interest rates were at zero, right around 2008, 2009. Now, we are not officially in a recession, but this does ring a lot of bells from people who are investing and working in that time, that this was a very similar time that cut interest rates to zero. So what does this mean? As a consumer, the interest rate on your bank will drop at some point in the future. Now, just because they cut it today does not mean it's going to, you're going to wake up tomorrow and your nice little CD or whatever just drops to zero. It will go down. It will likely go down in the next few weeks or over the next few months. That's typical. Your interest rates on your credit cards usually will drop. If you are looking to refinance a mortgage loan, this is the time to do it. If you're looking to get a new car loan or refinance that, this is the time to do it, because those interest rates are going to go down. This is great for those who are borrowing, great for borrowers. But for those of us who are savers, this is not good, because now if I was going to an online bank or any bank to get a higher interest rate, that's not going to benefit me anymore. Those higher interest rates are going to start dissipating. So it's not going to help me. If I got a CD a year ago or 2 years ago, great for you, because you locked that interest rate in. So it's great for borrowers, not great for savers. But for investors, what does this mean for you? So at this point, I want to run to the whiteboard here. Disclaimer, there's a toddler running around here somewhere. Also, my handwriting is really bad, so fair warning. All right, so we talked about interest rates. I talked about what it changes for you. We know it is bad. Actually, I can just do this in red. Let's do this. And all right, it is bad for savers. That means banks, or we'll say savings accounts. Savings accounts tend to go down. Those interest rates just those aren't good anymore, or aren't as good. And it's good for borrowers, and then interest rates here. So credit cards, mortgage, and just general other loans, those rates tend to go down as well. So if you're borrowing, hey, this might be a time to refinance. This is a great time for you to kind of pay off additional credit card debt if the interest rate is going down. If you have a mortgage, refinance. Like these are great times because it's at zero. And the reason why it's at zero, remember, is if the banks bank at the Federal Reserve and the Federal Reserve is not going to pay them any money, they have to go somewhere else. And the only other way, primarily, other than fees, the only other way that banks make money is, hey, I need to go make these loans then. Because if I can't keep it here at the Federal Reserve and get paid here, I need to go make these loans, and that's what's going to pay me. I need to go lower these credit card interest rates so people will spend more, and I can charge them off of that. That's how they make that money. Because they're not making money leaving it in the Federal Reserve because interest rates are now zero. There's no point in them doing that. So now they're going to start to loan the money out, which also helps businesses too. If you're a small business owner, you need to make payroll, you need to buy new equipment. Hey, if interest rates are low, you can afford these things a whole lot easier. So this is going to help borrowers, this is going to help business owners, and it can help you if you are in debt. But if you're a saver, it's not going to help you that much. Now, the second part of this is what can you do? What can you do as an investor, and how is this going to affect the stock market? Usually, the stock market goes up when interest rates are cut. Usually. That is not always the case 100% of the time. When the Fed cut interest rates, I think a week, maybe 2 weeks ago, the market actually reacted negatively, and it did not go well. So in time, we're going to see. However, what you can do, you should still be saving. Still save money. You don't want to, just because your interest rate dropped, doesn't mean that you want to like leave and just get out of it altogether. So that's one thing. The second thing is it is going to affect the market. When interest rates drop, usually when this happens, interest rates go down, we know that it is usually not a great economic time. People start to go for what's called defensive stocks. You've heard me talk about defensive stocks before. These are the stocks that tend to do well. I'm not telling you to invest in them. I'm telling you, you can go look at it and see if it works best for you. These are the 5 stocks that tend to do well. These are my 5 favorites. Stocks that do well in low interest rates. There should be an E here. All right, stocks that tend to do well. Those tends to be Walmart. That's WMT, Procter & Gamble. I keep telling y'all about Procter & Gamble. Y'all gonna thank me 2 years from now. Costco. Coca-Cola tends to do well. And then Colgate, Palmolive, they make the toothpaste. People are always going to buy this stuff, always. But when interest rates are low and the economy isn't so hot, those are the stocks that people tend to go for. These are the companies that tend to do well most of the time. Again, that's not a guarantee. Those are just ideas for you to look into. But again, consumer staples, that's what they call that. Those tend to do best in times like these. So again, what's happening? The Fed has cut interest rates, which means that all the interest rates across the board are going to go down if they're variable interest rates. If you lock yourself into, let's say, a specific loan, if you don't refinance, you're going to get the same rate. Unless it's your savings account, it's going to drop. So banks are going to have to look for other ways to spend their money and make more money. They're going to lower the interest rates on loans. They're going to lower the interest rates on mortgages, so on and so forth. You as an investor, or as a saver, your interest rate is going to fall on your savings account. If you had a CD from a year ago or you had a CD before today, that interest rate is locked. So if you had a CD from 2 years ago, that's perfect. You're going to be okay until that CD expires. But again, the market is going to react tomorrow. Right now, it looks like it's going to be down. I don't know how it's going to end. You never know how those things are going to end. It is meant to boost the economy. It is meant to help business owners take out new equipment, make sure they can make all those payments, and like make sure the economy goes through. But again, as an investor, those are the 5 stocks that tend to do well in times like these. These are stocks I've told you about before the interest rate, and they're likely to continue to do well or better than what the market is overall. So again, that's Walmart, Procter and Gamble, Costco, Coca-Cola, and Colgate. Again, the reason why people are going to buy this stuff anyway. As the virus continues to do what it's going to do, people are going to continue to buy toilet paper. They're going to continue to buy soap. They have to buy food. They have to get water. Where are they going to get those things? They're going to get them at a Walmart or a Costco. Who makes those things? Procter and Gamble, Colgate, Coca-Cola. So you're getting both sides of those if you're a long-term investor. As always, do your own research, see if it fits for you. And I would also pay attention to how you invest. So the market has not bottomed out. We don't know that. So I don't suggest putting in all your money at one time. My best suggestion is do what I do and do what most people should do is invest on that monthly basis. So if it's 1,000, if it's 100, whatever it is, you're being consistent each and every month, and that's what's going to help you out. You're not going to be able to time the market. You're not going to be able to say, I'm going to invest when it comes up, because by the time you realize that the market is coming back, by the time it's up, you've already missed that lowest point to really make the biggest gain. So if you're consistent, that's going to help you out. All right, there's a toddler banging on the door. I will see you guys later. I'll keep you updated if anything else happens. Make sure you hit like, subscribe, follow, all of those things. And I'll see you guys later. My name is Kevin Matthews. Peace out.